On August 5th, we saw one of the largest VIX spikes and subsequent crashes that the market has ever seen. The VIX opening the day above 55 before crashing down and subsequently closing at 38.51. Since then, the VIX has continued heading lower all the way to the point now where the VIX is below the 15 level last seen 2 weeks ago. If we go back in time and we just take a look at some of the largest VIX spikes and crashes throughout history, comparing to the VIX spike we saw during COVID, the largest VIX spike we saw during the financial crisis, and even going back to 1987. The spike we saw on Monday, August 5th was one of the largest of all time. And so in this video, we're going to take a look at what this means for the market. We'll take a look at the SPY and the Q's GEX data to see how the market structure has shifted. We'll also take a look at some economic data and the yield curve un-inversion that is currently taking place. So let's jump right in. Here we're looking at a 30-minute chart of the SPY along with our GEX data, which is highlighted here in the purple bars. Take a look at the open on August 5th down here at the bottom. That was the cycle low, it looks like, at least temporarily, bouncing right at the open, market just continuing higher throughout this past week. The gamma exposure data has been leading us higher, and we see today we still have gamma exposure growing at the higher strikes, 555 on the SPY. We even see some GEX growing here at the 560 level. So these dealer clusters have a high probability of shifting upwards up into these levels. And so that's something we're going to be watching very closely. Let's take a look at the QQQ and see what the GEX data looks like there. The tech sector, along with semiconductors, have had a really nice rebound as well, coming off of some weak earnings reports for Q2 and have really been just leading the market lower until this VIX spike here on Monday, August 5th. And ever since then, we've been in an uptrend. Again, coming right into this dealer cluster today, we do see this potentially shifting higher to the end of this week, maybe into next week, into the 480, possibly even the 485 strike on the Qs. Taking a look at the Qs on our 3D surface model, these are of course 0 DTEs pointing at 474. But if we zoom in here further out in time into the September expiration, September 20th, that's that 485 strike that we mentioned, currently the largest gamma exposure concentration. So this 480 to 485 zone could be a potential target here in the coming weeks. That's really not that much higher than where we are now, last price 473. So we're talking about 2-3% move in the coming weeks, which makes sense if this bounce continues. Let's take a look at a couple of names we've been watching and trading. SMH is one of the names we've been trading in our community Discord. By the way, I'll put a link in the description below. If you're interested in hopping in there, come check us out. A lot of great traders discussing what they're doing every day in there. If you watched our last couple of videos, we've been talking about the downtrend in SMH, which we broke out of here on Tuesday and have been rallying ever since then. Leading up into this trend line, in the days prior to the breakout, we noticed zero gamma was right above the trend line as well. So looking at the data and the potential market shift with gamma exposure strikes growing at the 260 and 280, we felt like this was a really great place to put on a long iron condor play. And so with this move today, that's actually playing out really nicely. Another big mover today is Nvidia. Nvidia got absolutely killed in the sell-off, trading below 95 at the open on that VIX spike, but has since really just outperformed well, coming all the way back into these large gamma exposure clusters. You know, we follow gamma exposure data very closely, and these large GEX strikes were holding steady at the 120 and even 125 strike. It was hard to believe that we could see a 20% rally back up into these levels, but that's exactly what happened. Let's come over here to our 10-year, 2-year yield curve inversion chart. We've been watching this for quite a while, really wanting to see whether we're going to uninvert. We've been inverted on the 10-year, 2-year yield curve since July of 2022. As we mentioned in our last video, this is oftentimes what we see as a precursor. Let's just zoom out on the chart here. These yield curve inversions are often precursors to recessions. You can see the gray zone is a recession. And the blue line is the 10-year, 2-year yield curve. So when it drops below zero, this is what's known as an inverted yield curve. And what that yield curve inversion means is that the 2-year US Treasury bond is yielding a higher percentage than the 10-year US Treasury bond. You can see here, 2 years yielding 4.09%, 10-year is yielding 3.92%. Obviously, as you go out in duration, the risk increases, and so technically, the longer term duration should be yielding a higher percentage. When that inverts, usually it means there is some fear in the immediate term for the economy. And so what we see is that that unwind of that yield curve typically precedes weakening economic conditions and potential recession. I think this is a near perfect indicator, historically speaking, and so we're watching very closely to see, is this about to happen again, which would signal we only have a few months left before the US economy is officially in recession. But until that happens, we can easily be in a risk-on environment like we've seen the past 6 or 7 trading sessions. It's even possible that we could see new all-time highs, which really would be the pain trade. I mean, all the shorts during this period here are now getting blown up if they have not yet covered. So we could potentially see continued short covering, and you can easily see how the possibility to get up into the 580 or even the 600 level here on the SPY coming into the end of the year is a possibility. So we have a lot of short sellers unwinding right now in the market. We also have a strong possibility for a Fed rate cut here in the September FOMC. So we have a few weeks ahead where the market is looking forward to those potential cuts. That could potentially add fuel to the fire, giving us a continued boost in the market, maybe a last upside capitulation before the recession actually comes into play. In the meantime, we'll be continuing to monitor this data on a day-to-day basis, making tactical trades for our own portfolios. Come over to our website if you're interested in accessing the tools and analytics that we provide, geeksoffinance.com. I'll put a link in the description below. I'll also put a link to our free Discord. You can come check it out, say hi. We'd love to see you. Members also get access to our Geek University course. It's a 5-hour option strategy course. We discuss volatility, gamma exposure, and our overall trading strategy. Anyways, that's it for this video. Thanks so much everybody for watching, and we'll see you guys in the next video.